All right, we're diving into strategy number 8, and this one's a big one. It's all about arguably the most famous indicator in all of trading, the MACD signal cross. After tackling the beast that was the Ichimoku system, we're taking a step back to something that looks a lot simpler. But don't let that clean look fool you. Its simplicity is actually what makes it so powerful.
And this really gets to the heart of it. It's kind of funny, isn't it? The MACD is on literally every trading platform out there, from the app on your phone to a high-end Bloomberg terminal. And yet, I'd bet most traders are using it completely wrong. They just see a line cross another line, they click buy, they click sell, and they have absolutely no clue what's actually happening under the hood. Well, today, we're going to fix that.
So before we even think about entry signals or strategies, we have to get back to basics. What is the MACD actually telling us? See, it's not just momentum. It's way more specific than that. It's about the momentum of a trend. Think of it as an indicator that tells a story about how two different perspectives on the same trend are getting along.
And here it is, the big secret. The MACD line, it's just the distance, the gap, between two different exponential moving averages. You've got a fast one, the 12 period, and a slower one, the 26 period. That's it. It's just measuring the space between them. So when that gap gets wider, what does that mean? It means the trend is picking up speed, it's accelerating. And when the gap starts to shrink, well, the trend is losing steam.
This is where the name comes from, moving average convergence, divergence. It sounds super technical and complicated, right? But it's literally just describing what those two moving averages are doing. When the EMAs are moving apart from each other, that's divergence. The trend is getting stronger. When they start coming back together, that's convergence. The trend is weakening. The name tells you everything you need to know. So the MACD indicator isn't just one thing, it's more like a little system made of 3 different parts, and each one has a very specific job to do. You've got the main line doing the core measurement, you've got a trigger line that actually gives you the signal, and then you have this cool visual tool that kind of acts like an early warning system. Let's break them down one by one. First up is the MACD line itself. Like we just said, it's the 12 EMA minus the 26 EMA. Now, when this line is above the 0 line, it means the faster average is on top of the slower one. That's a bullish picture. And if it's below 0, it's bearish. This is cool because the 0 line cross is basically an EMA-based golden cross or death cross, but simplified down into one single clean line. Okay, component number 2, the signal line. This one's pretty simple. It's just a 9-period moving average of the MACD line. Its only job is to be a slower, smoother version of the MACD line. And the big trade signal that everyone talks about, that happens when our faster MACD line crosses over the slower signal line. That's the trigger. That's the moment that tells you momentum is shifting. And rounding out our trio is the most underrated piece of the puzzle, the histogram. You know those little bars that go up and down? They're just showing you the gap between the MACD line and the signal line. But their real magic is that they're predictive. When you see those bars start getting smaller, you know the two lines are getting closer together, and a crossover is probably on its way. The slope of this histogram is your heads up that momentum is slowing down before the actual signal happens. Okay, so we get the parts. Now, how do we put them together to build a trading strategy that actually works? Because just trading a raw MACD crossover can be super noisy and get you into a lot of trouble. So we're going to add 2 really important filters to make our system way more robust. Our first upgrade is a big one. We're putting a 200-period exponential moving average on our main price chart. And the rule here is simple, but you cannot break it. We only take long signals from the MACD if the price is trading above this 200 EMA. And we only take short signals if the price is below it. This is our guardrail. It keeps us on the right side of the big long-term trend. And now for this second upgrade. And honestly, this is the one that most traders completely miss, the 0 line filter. Here's how it works. We only take a bullish MACD crossover if it happens above the 0 line. Why? Because that confirms we're in an already established uptrend. And for shorts, you guessed it, we only take a bearish crossover that happens below the 0 line. This is such a powerful filter for weeding out low-quality signals. Okay, let's put it all together. Here are the exact entry rules for taking a long trade. Step 1, is the price above the 200 EMA? Check. Step 2, is the MACD line above the 0 line? Check. And finally, step 3, does the MACD line cross above the signal line? That's our trigger. When all 3 of those things happen, we've got a high probability setup. Now, getting in is only half the story. You gotta know when to get out. Our main exit signal is a reverse crossover. So when the MACD crosses back below the signal line, if you want an earlier heads up, keep an eye on that histogram. If the bars start shrinking towards zero, that's a sign momentum is fading. And of course, for risk management, our stop loss goes at the most recent swing low, and we'll aim for a take profit target of 2.5 to 1. So, we have the theory, we have the rules, but the million-dollar question is, how does this thing actually perform? How does it hold up when you backtest it over years and years of data? And where does it really stack up against the other strategies we've looked at? Let's get into the numbers. And here we go. This is the performance table for all 8 strategies we've covered. You're seeing the win rate, risk to reward, annualized growth, the whole shebang. And if you look closely, you'll see our MACD cross strategy lands right smack in the middle of the pack. It's got a solid 58% win rate, a 2-to-1 risk reward. It's a really respectable and consistent performer. It's not the chart topper, but it's solid. Which brings up a really interesting question. If it's not the absolute #1 best performing strategy, then why? Why is the MACD on pretty much every single trader's chart across the globe? Why is it the default tool for millions of people? The answer, as it turns out, has less to do with raw performance and a lot more to do with something else. The MACD's mega popularity really comes down to 3 key things. First, accessibility. It's just everywhere. You don't have to go looking for it. Second, its design is incredibly intuitive. A crossover is a super clear signal, and that histogram makes it so easy to see momentum shifts with just a glance. And third, its versatility. It works pretty well on all markets on all timeframes. It's kind of like the Swiss Army knife of trading indicators. And that leaves us with one last thought to chew on. The MACD is a master at measuring the momentum of a trend, its acceleration, its deceleration. Its entire purpose is based on movement. But what do you do when a market just goes completely flat? When it's stuck in a range and there's no momentum to measure at all? Well, that's the indicator's biggest weakness, and a great reminder that no single tool is perfect for every situation.